Morning, Alf team. Planter here. Week commencing 3rd of June 2024. So we're into June, and good riddance to May. How wet has that been? Fed up a bit. But we had, as you can see, a lovely weekend. I've been outside doing the hedges and various other things have been put on my chore list. So, yeah, my gingerness shining through nice and brightly. Um, yeah, so yeah, expect in the weeks ahead potentially the retail sales figures for the UK to be bad again on the back of that because the footfall was dreadful, and everyone I know that's popping into Cambridge can't believe how quiet it is. It's my local city. Kind of fits with the whole end of May, really. Markets in consolidation mode. Some have already done what looks like double extensions. Then we had the late rally on Friday. Is that just merely another connector to doing a further double? We'll have a look at a number of the indices, see how they're set up. They all seem a little bit similar. They need new highs, obviously, to confirm we're back in the uptrend, or we may just be going sideways until that eventually comes, but it will come. Pretty sure about that. And it's a new chart here from Jurian Trimmer and his team at Fidelity. They're really, really clever people. We've seen the Bank of America data before suggesting that June to September in presidential fourth years is strong, and these guys have confirmed it at Fido that, and that's especially the case if the midterm year, i.e., year two of the 4 year US presidential cycle, is a negative, which we had. We had that big market sell off in 2022. So it almost bakes in further performance. And I've heard Bloomberg shouting about there's a number, I can't remember who did the study, but a number of incidences when the performance of the S&P by May is 10% and above. On only two occasions as the end of year ended lower than that. So we should be in what is a positive backdrop still. It's been our central case for a while. Is that supported from the market? Well, hard data, the big red folder, as if you like, in the way that you look at it, data points are all seemingly softening, coming in a little bit lighter, helping the whole no further rate hikes at the very least, if not moving us closer to the US rate cycle in a down mode. And then the secondary kind of survey things are all coming in a little bit higher. So in a way, that's a perfect mix. So you get the fear into the market, and then the actual data points are coming in a bullish mood. But the market wasn't having it last week, was it? The bond issuance was finally beginning to tell, even though it was in the 1 to 7 area. There was just too much of it, 119 billion, and that left the market quite scared. End of month, it seems that there are some trends out there of hedge funds selling US stocks, potentially buying around the rest of the world, probably in that kind of hedged exposure still, long, short America, long Europe, and some of the emerging markets probably. So that was leaving the indices off and over. The dollar was in a kind of nervous, jittery mode. Again, is that end of month flows, or was it putting in on from the technical side the double extensions? It is in a downtrend still. We keep showing that it's in this step fashion. One's down, two's back, but they keep being quite complicated consolidation patterns, and so it still seems on the back of the US consumer confidence number coming in higher and being revised higher from the previous lows. The market got a little bit jittery, and the dollar itself started on another extension higher, which we highlighted straight away in the real time chat. And then this week we're into what should be some other central banks entering into their rate cutting cycle. So we've got the Bank of Canada expected to cut 25 basis points, and the same at the ECB on Thursday. So look out for those two events. Consensus is for a cut at both. And yeah, that's Europe moving in spite of wage data jumping up, and CPI jumped up on this whole mainly on this German rail fare year-on-year drop off. That's where they brought in a fixed price, I think it was. And that just brought in some much lower numbers last year, which have rolled off, etc., etc. Now, it's interesting now that the ECB are probably going to go, and then there's going to be rhetoric around it, narrative change. it's been pushed out in advance that they'll hold back, and there's enough in that data last week, wages and CPI, just to be able to get everybody backing that, unless the data deteriorates in terms of doing the next cut in September. But even so, the Fed and the Bank of England must be gutted. The Fed should be leading, and the Bank of England, Bailey likes to lead. He led on the way in. The rate rises. So look out maybe for a slight change in narrative, not just being data dependent, but not wanting to get too far detached from what Europe's doing. That can easily be something that becomes introduced. How's that going to affect EU and GU? Well, if the rate cuts in the Eurozone are pushed back a little bit and the dollar finally tops out, then we would be expecting to see some strength. So we'll have a look at those charts. I think they're also probably finishing off consolidations before they move higher. A lot of it is dollar dependent again, I think, and we've got a very heavy data set this week, which is mainly PMIs across the world, and we've got ISM Monday and Wednesday, and then we've got JOLTS, ADP, and non-farm payrolls on the US employment side, which always have a massive effect. And we'll be all over that as the week progresses. The consensus is for not much of a jump, a small jump back in non-farm payrolls, but we shall see. It's all about the revisions, all about the mix, and ever more so at the moment with things deteriorating. And a lot of the regional US PMIs have been a little bit soft on the manufacturing side. So let's see whether that comes through on Monday in the ISM figure. But really, most eyes are on the prices paid elements of those reports, something that we like to keep you abreast of. Something that's really been there over the weekend, the strength of Nvidia. We saw it last week, 20% up while the market was coming off. And really, we only really saw Nvidia profit taking at the end of the week, just as the market rallied. So it's a bit of a mixed picture. We'll have a look at that again in detail later. But Nvidia, the only roadblock to its outperformance has seemingly been the fact that people are taking up their products so quickly that they might run out of actual ready-made chips. But they've come out over the weekend talking about the 2026 chipset, and so we're already on the rollover from stage 1 to stage 2, and they're readying stage 3. And then AMD have come out saying they've got some chips to rival. So the whole space isn't imploding; it is growing. And then we had that Musk $6 billion raise, which apparently at that stage of a private equity raise is one of the biggest ever, if not the biggest, for that level. So what's he going to do with that? I mean, the whole point of this is Nvidia are effectively the shovel sellers for the gold mining outbreak, and that's the similar stage for AI. People are building out their infrastructure and they're buying their shovels from Nvidia and such like. It just seems amazing. We talked about buybacks being a big support for the markets, but one other thing that normally does give a kicker to a share price is a stock split from a high price to a lower price. There's no change in value. There shouldn't be any movement, but there seems to be this psychological effect of people preferring to buy a lower price share. So if Nvidia does this 10 to 1, well, they are going to do the 10 to 1. They'll go from 11.50 down to 115. Is it unthinkable that stock may double in short order? Now, if it does, due to its weighting, that'd be something like 7.5% on the S&P and the Nasdaq straight away, without anything else moving. So we now get into amazing extremes. But the fact is, the more you look at Nvidia, the stronger the earnings are, the more justified the rating. And the rating obviously is, as the earnings appear, it is de-rating from the crazy highs, but it's still highly rated and set to be driving the rally that we're expecting forward. So I imagine things will become nervous going into August when their next update comes, and that will fit potentially with the topping out of this seasonal rally. Gold, lots of chatter on my chat. We've looked at it a lot on the live channel. It's right on the trend line, the neckline for a 4-hourly close below that neckline, which we've been waiting for. And then the drop down sits with the downtrend channel consolidation channel that I think we're in, and it all adds up to something around 2250 before we get the bounce. So hopefully that comes quicker, doesn't drag out, and we get the kind of V-shaped recovery from that. And if we are, as I said, write a note wherever you want to put it. But if gold's bottom, then silver has, and silver is definitely outperforming at the moment, going up more and not seemingly not pulling back as much. So we really want to be picking it up for this next breakout. Looks like the period where it will outperform gold. Excuse me. The other thing that appears, and we'll look at that chart, to be in breakout is the US Treasuries, the 10 years. So we're in a data-heavy week. What is that implying? Well, we need to have a new high short term to confirm that pattern. Does that suggest we're going to have some in line to slightly weaker growth data, which may just cause a bit of a two-way pull again, see the indices, etc., fall down before people start to factor in the fact that hastens the rate cuts and the Fed put, and we start to rally again. So that could be just enough to see the bonds rally, equities finish their consolidations, and then have a bounce. So let's keep that in mind as a playbook for the week potentially. And in no way do I think we're overcooked in this cycle. As an old friend, sadly departed, used to say, buy until you're scared when you see a proper opportunity. Just keep buying until you have to actually start worrying about it. You'll be okay. The VIX slipped back into fear zone. We said we might start seeing a bit of range trading on that and see it jump up to the kind of 15 level, and then we'll have a look just how it moved on Friday. That was incredible. OPEC met yesterday and Sunday, and that was really, really underwhelming. They've extended their current cycle of cuts into the latter part of 25, but people were looking for a longer duration to that and possibly an increase. So there's not really been much of a flicker to the oil price. It's still underwhelming. America seemingly have the upper hand in that whole setup. And to me, that has a tinge of panic coming from OPEC Plus. The Saudis were allowed to have a bigger proportion of the production because they've been out of kilter, but they've set out already a plan to try and roll back these cuts at some point. I think they're realizing that they've messed up a little bit here. So oil firmly held in the trading range for now. We need something to change massively in that demand supply mix. What else we got coming up this week? So I said that the overall is the Bank of Canada and ECB rate decisions. We've got PMI data, manufacturing and services, and ISMs all across the globe. And we've got the employment data. And then running through what else we put up there. In time for the edit, I managed to put in the manufacturing PMI and Aussie came in slightly above, but still in contractionary mode. That's some sort of relief for them at the moment. They're a little bit worried about their data set as a whole, being a little bit too hot, maybe needing another rate hike. Japanese manufacturing, that was slightly lower. China, again, we mentioned last week, their national PMIs still in expansion mode, but contracting this month, and Caxin we expected to be the other way, and so it proved. They've come in slightly higher. That's the private one. Later on, we get UK and Europe PMIs today, and then US PMI and ISM. There's auctions and Atlanta GDP, just worth mentioning because some people last week were using the Atlanta GDP still running at 3.5 for Q2 as being a reason not to panic about the pullback in the second reading of Q1 GDP. But once all last week's updates went through the sausage machine, they've now pulled that back down to 2.7%. And there's enough data this week to see real-time updates again. So we'll see how that turns out. But it does look like there is a little bit of slowing going on in the US. So it's all helping the definitely no more rate hikes in line to eventually cuts narrative, which at the end of the week, Williams kind of reiterated, saying that he thought there'd been enough tightening policy. Otherwise, we wouldn't have seen the effects we've had in the last year. But he, again, doesn't think there's a rate cut coming too early, despite the fact that they are on track to be at 2.5% on PCE for the end of 25 and to be in line with a 2% idea going into 26. So all on the right path, according to one of the most important guys, the New York Fed guy, John Williams. Tuesday, UK retail sales. I said, don't expect anything great from that. I'll be surprised if that's an uptick. So that could be a well-needed positive for the rate cut in June or July for Bailey. Aussie trade data and retail sales. Again, we need that to be a bit softer. Japan 10-year auction. I've got some comments within the piece about 1% yield on Japanese bonds, JGBs, might just be enough to see people start to switch back into them and out of treasuries. So even though the BOJ, the Bank of Japan, won't be doing that unwind, just getting that yield back into sort of useful buy territory for yield players could be enough to actually take a little bit of pressure off UJ. So keep that in mind and look out for any news flow coming out of auctions in Japan. We've got Swiss CPI, Eurozone unemployment figures as well, and then the start of the US ones, JOLTS, and also the API oil data is back to its normal day of Tuesday. Wednesday, New Zealand trade data, Aussie services PMI and GDP, Japanese services PMI, Chinese one, UK and Europe, and the US also. So it's a massive day for PMIs on Wednesday, as it normally is on that week. There's ADP private payrolls that feeds for expectations on non-farm private payrolls. And it's the Bank of Canada rate decision, 25 basis points cut expected. Into Thursday, Aussie home sales and building approvals is the best of their data. Euro and UK construction, leading indicator. Euro employment and retail sales. The ECB expected 25 basis points, as we said, and US dollar productivity and initial claims. That productivity number's been a little bit mixed of late, and we certainly want that to be improving again to help the whole high real rates argument. Friday, Japanese household spending and some leading indicator data. The UK sees the Halifax house price index, France and German trade data, Euro GDP. Canada has its employment data around the time of the US non-farm payrolls. And then there's a late one from China. I don't know why it's out in the afternoon, but there's some Chinese trade data on Friday. Talking heads will be quiet. We mentioned it last week that we go into an important week this week with the ECB, etc. Everyone on lockdown, and it's a similar thing for the talking heads of states because their meeting is the following week on it'll be the 10th of June. So there's very few people around. Anyone in Europe will have no market impact because they're not allowed to. So there'll be general prepared speeches. Nakamura is on the roster for Japan on Thursday morning. Nagel and Schnabel are back out after the ECB decision on Friday. So there may be comments that are useful on Friday. And again, Fed's Cook is the only one on the roster this week on the rota. And she won't obviously have any impact as a result. Earnings-wise, that is super quiet. Got very little on Monday. Ferguson, the old Woolsey, and Hewlett-Packard on Tuesday. Inditex on Wednesday, and very little outside that. Not many big names. We are at the end of Q1. So jumping into the charts now, and very much just showing you there the Atlanta GDP figure that came in. So everyone had been focused on the fact growth was holding up Q2 based on the real-time model of the Atlanta Fed, but that suddenly had a big catch-up as of last week's data. So expect to hear commentary about that there is evidence that the slowdown is having an effect now. Dollar-wise, we've been talking about the one more turn. We had the sell-off. We're looking for that bounce to sell off again. We have, but the consumer confidence around here and the rate auctions, we said, is that ended up being a connector rather than the new downside? And so it proved we put in a new high for the move. Is that enough? Again, we've sold off, deep sell-off. It feels pretty much like unless we put in a new low here. It's quite important around the 104.4 in the near term. We're more likely going to do this double correction. What we predicted on Wednesday, the 105.4, before we're finally done. It's a data heavy week, a lot of flip flopping likely. So that should read through to what we're going to show in a minute on other instruments, the indices, and commodities, etc. So gold itself, that has it's come back into the trend channel. We predicted we might have relief rally on Friday on the PCE, get some breakout, which it came back into the channel. We've put in a new low, and this blue line across, which will show on the 4-hour where it was identified by one of the guys on the system. If we get a close below that, then you should expect to see some acceleration. We're still looking to hit the bottom part of that trend channel. We've had 5 down. I think we've had a connector. I think we've had a 1 and a 2 now. That was a 3-wave up. So that's really favouring a consolidating 2-wave there. And we're somewhere in the lower subwaves of a wave 3. And there should be a lot of the heavy lifting, heavy work done in the near term to get us down there before we can say that we're hopefully going to bounce off the bottom of the channel and be in the 5th wave up that we've been waiting for. So the quicker this happens, the better, really. And let's hope that does play out with the data. There we have it on the going through the closes. The left shoulder was over here in the head. And then we're coming in here. You need to see a close below the neckline. And if we get that, we should get some acceleration downwards. It's going to flip-flop around, but if you can have a series of sells there and it doesn't come back above the trend, the neckline, and hold, then it should still be valid. So let's keep an eye on that, see how that progresses. Silver, lots of signs of it being impulsive versus gold to the upside. Gold's been heavy down. Silver's sort of tracked that, but it has been outperforming on the upside. So overall, it's the outperforming asset. It's nearly done a double equal legs into what looks like an interesting gap and support zone here. So let's hope we bounce off that. In the old Ron Seal advert of the past, it's literally doing what it says on the silver tin. Look to buy silver into the pullback. Nasdaq 100. It's pretty much a pattern of a lot of the indices here. Had we topped out, were we putting in a 3-wave before we rallied? We talked through this on the live show, and we'll do it again today in real time. But we sort of said if that is going to have a rally in the crazy expected volume of Friday, then would it just be a connector? So we kind of anticipated and put in where a sort of 50% retracement would be, and from there, where would an equal legs look? Well, we've almost bounced back to that late buying. And if that does end up being roughly where the next sell leg comes for a further extension, then the 1-for-1 does indeed take us down to the bottom of the upward trend channel. We've already got the extrapolation of this wave finishing at the top of this channel for a double confluence, which we looked at on Friday. That would be really super neat if we could put in an extra sell off here and do some classic bouncing off trend lines. But all said and done, it has done enough to be valid. It just ticked below the 1.618 and came back intraday. So we can kind of say that isn't necessarily the start of something impulsive. But again, price action will confirm that. But I do think this will develop as being, rather than a full-on 5 waves, super correction from here, start of a larger wave 4. I think this will be the ending part of the current consolidation, which looks like being a minor wave 2 of 5 to finish off. The intermediate wave 5, and then we'll start getting a proper consolidation. But we'll look at all that if you want on the live show. S&P wise, on the daily, you can see that has put in what looks like an equal legs, slightly bit more sell off. But really, I wanted to leave it as a daily there just to show how the full S&P looked versus the equal weight, but it's very much having the similar action with decent sells on Tuesday and Wednesday, followed by rallies. But the difference being the equal weight on Friday was a big jump, whereas the overall index was quite lower. Why was that? Well, that was the first couple of days that actually Nvidia sold off. Nvidia was up on the first 2 days when the market as a whole was down. Lots of info in the background. We mentioned it, the Musk info with the raising, so that allowed it to outperform. And then finally, the early negatives of the market, a bit of profit taking kicked in, and there were a few just other things going on in that AI space, the Salesforce thing, one or two other smaller read throughs directly from AI, the Dell weakness on which was supposed to be an AI boost, blah blah blah. So there was just enough to get a bit of profit taking coming in Nvidia, and that is where. So that's quite interesting that we had a big move up in the equal weight despite Nvidia coming down. So if Nvidia is only an equal weight, it's not its big 7% as normal. So that showed you, we talked about it, seeing some rotation. And this was one of the cases where that Nvidia was on its own, really. The other big tech stocks were rallying. So that is the sort of time when you can get this escape from just being dominated by the one stock. But I imagine normal trends will resume pretty soon. And as I said, there's more and more positives coming out in the short term already on Nvidia. So another boost for the market being in a consolidation phase. The Dow, similar situation. We were talking about how mixed this one is because it looked like it had put in a wave 3 and 4 here into the April 19 low. And then we've put in what could be argued as being the 5 waves, or it could be a 3 wave. Because remember, the C legs of all consolidations are always 5 waves. So you need to be aware that these things can be interpreted in 2 ways. We haven't had a new low for the move, so it's kept us thinking that's still a valid 5th wave doing a 1-2. But if anything, the way that's constructed, it looks better as a 3-wave connector, and it's all about what's happening from Friday onwards. Again, we put in what is potentially an estimate for an equal legs if it were to continue, and that gets us down here to sort of 37. And the previous idea of an equal legs, it's kind of maximum 1.618 is in the middle of that range, so you could potentially see that coming in as a what will end up being an equal legs 3 wave 3 swings scenario, so that would move the intermediate wave 4 over here. So then we'd be breaking out into the final wave. So this just probably is a little bit neater to expect this to be a larger degree wave 4, just looking at the way that things have been playing out. So I'm quite happy to redraw that as being an A, B, C, or a W, X, Y, because there's so much substructure. It'll be a W, X, Y, and again, we'll be off to the races once this puts in the final move down. So potentially over this week, a bit of choppiness, and hopefully 3-wave pattern ending in a 5-wave sell-off, and Bob's your uncle. The DAX, similarly, we've been doing this very shallow consolidation, which is twice now gone into a double. We've had the bounce back up. The question again is if all the other indices are coming off, and there will be nervousness going into Thursday, even though it looks like a given. You could easily see this doing another shallow retracement, and look at it, it's only a little bit lower than the low we've already had to get equal legs in over here. And then we're back to looking for wave 1 equals wave 5, move towards the top of the trend channel. So that one sits in line with everything else, but be aware that be very careful selling it, because we are in a valid move up. So keep the stops tight. If it comes off, be aware that it shouldn't be too deep. So we should be able to catch somewhere close to both of those turning points, subject to data, really. The Nikkei, that, as we said before, been playing out like a dream. We had this breakdown channel, which was an equal legs. And as I said, I forgot to post it for various reasons until we moved to about here, just because I got taken with doing something else. But if anyone that was playing it, was watching it, was waiting, that is a valid wave 2. Whether it's going to have another extension or it is a breakout, this is the classic of you should have been buying, because you're going to get at least a 3-wave move. So this could be an A consolidation and then another 3 waves to finish with 5 waves in here, maybe just another small high before it sells off. If it does go back into that pattern again, this should be the end of it, aligning with the other indices, and then we're into the proper wave 3. So that will be back aligned with looking for strength, etc. in the Nikkei, whereas we were playing that knowing it was a sideways move while others were trying to rally. But that was absolutely pro forma. Hope anybody got on that, because it was absolutely spot on to the pattern. FTSE, again, that has done enough to have been the wave 4 that we're playing in. But again, and if the other indices are doing it, I don't think there's enough around in the UK space to demand that the FTSE will be leading. So this very much has the feel of a connector along with the others. So we're looking for a potential equal legs off here. And again, having not quite hit the equal legs on that move down, it could be noisy and still part of the first leg. Either way, I'm expecting to see some kind of selling into this zone. That means we may have a classic retest of 8,000. Wouldn't rule that out, and that'd be quite novel, wouldn't it? And an absolute bargain opportunity. So fingers crossed we get the pullback. It's complicated if it keeps moving up in the short term. On the currency side, we said we're looking for that dollar topping out. So that might mean that we are again in the connector phase of the wave 2. Rather, I mean, it's validly could have finished as we were starting to rally here. In order for that to be valid as a 5-wave move up, we do need, unfortunately, a new high. So look out for that. 108, 1.08824 was the high. So again, that could be a 5-wave, and we put a bit of short-term consolidation in, so it'll be choppy, but that will confirm that we're actually into the upside of the wave 3. Whereas at the moment, and with the way the dollar looks, get that one more dollar upside, we should get one more euro downside, and then back into an up leg. GU, very, very similar. Is the dollar sell-off coming yet, or is the dollar strength going to put in the end of the wave 2? We haven't quite hit the 1-for-1 yet. It hasn't taken out a new high either for the current connector setup, so it's almost the same. Needs to have a new high, and even then we could get some choppiness further. It's all in the short term going to be dictated by the dollar. UJ again needs a new high to confirm that we're in the bullish phase from the long dollar scenario there. Otherwise, this is a connector to the yen intervention impulses. But if anything, we're expecting the data to help. We're expecting the Japanese auction to help this week, blah, blah, blah. But it really needs something on the US side to get that going. We're a couple of weeks away from the Bank of Japan, I think. I have to double check the date of that. But yeah, so keep an eye on this. This is a daily chart, but we want to see a new high for the move, just to keep that in mind. Mentioned it earlier. 10-year bonds. They very much look like they've put in a 3-wave consolidation. We had a 5-wave down. It's a zigzag. Then we had a 3-wave, and then within here we've had 1, 2, 3, 4, 5 sell off. So that's a valid place to bounce, which it did. And again, it looks like we're in the early parts of 5 waves up, rather than being a connector, but again, we need a new high because that is still not advanced. That could have been the end of one, but because this is in a triangular pattern, I think that is suggesting barrier triangles get taken up to the upside. We saw that on UJ a couple of months back. So this feels like it's building for a new high, but if it doesn't, then that every chance that that is a connector and will come lower again. So important week, but it does feel like data, the hard data, because the hard data is easing, we should be getting the bonds, the yields coming off again, which hence bonds rallying. So it feels like we're in a breakout phase, but we're very close to the end of the first 5 up. So you're going to have a consolidation. So we're going to be stuck in this range for a while, which kind of makes sense with a bit of flip-floppy action for the week, and then hopefully see that yield argument be another boost for going back into indices. The VIX, and this is the bond side of it, they were both having a move up, volatility back into pricing, bit of fear back into market rates, particularly getting pushed back on the poor auctions, and it was happening in the equities. But just look at what happened with the rally in equities late on in the week. That sort of reversed from looking like it was going to go even higher back into the sort of 16 region, but then it was end of month, reverse engines, take everything off, and rally-tastic. So VIX back down into mid-trading range. As always, we've got last week as it happened, got all the talking heads, got all the memes and tweets in there as we went along. The diary, as always, is at the end, and you've got one of the most important bits. Make sure you just reaffirm what all the talking heads were saying last week, just to keep yourselves up to date, because as we know, Mini-Me, Kashkari has far too much of an impact, and even he was misquoted, I thought, a lot last week. So it's important to know what people are actually saying around the world. So hopefully that's useful. Join us on the live show with any questions, and good luck with your trades. Take care. Speak again soon.